maybe 2 to 3 times a week, doing some review of the markets. So in this session, if nothing else, I want to give you, I think, a broader overview of trading, and including, and I'll come up with some pithy title, like the philosophy of trading success or something like that. But I kind of want to look at the bigger picture. We talked a little bit about, some day trading stuff, some position trading, and if you came away with anything in these sessions, it's that position trading is probably the best thing that you could possibly do. But there are 3 different philosophies that I use when in trading, and this is after like 40 years of trades. And let me bring up my book. My little sketch pad here. And before I get started on this, do you guys have any questions for me on the Thursday session or any of the previous sessions? Oleg, did you get the email I sent you with the Excel spreadsheet?
Yes. I just added 5 more columns to it.
Oh, okay.
The graph. So, yes, thanks.
Sure. All right, so after 40 years plus of trading, there's 3 things that I do, and I'll call it a philosophy, if you will, but it's really more of a strategy. And number 1 is that I allocate 20% of everything I make into dividend stocks or ETFs. And for me, this is like a retirement account. So I want something that's going to pay a very nice dividend. And I already mentioned one, which was CHI. Pays 9.5 cents a month. And so I built up long-term positions in those. Now, this strategy of trading, investing is very long-term. And when I say long-term, I'm talking 10, 20 years if I live that long. So very, very long-term. I want to put a percentage of my income, and I've allocated 20%. Into dividend-paying stocks. I don't care what the price is. I try to do it when prices are good. So, for example, I purchased quite a bit of CHI in 2009 when it was near like $5.50. The one thing that you want to be careful of if you do use this strategy over the long term, is you can't do it in a margin account. You have to do it in a cash account. And the reason for that is if you put it into a margin account, you actually give up your dividends to, basically, if you're borrowing money from your brokerage account, those dividends will go right to the broker. So you don't want to do that. You want to do that in a cash account. Number 2. I call this long-term trading, but it's what we discussed early on, and that's position trading. And this is where the majority of the profits that you're going to make in trading come from. And when I talk about long-term trading, I'm talking 6 to 12 months. So, for example, when we first started the sessions, I mentioned at the end of January, I put on long-term put positions that expire in September and October of this year. And those are the kind of positions that you want to have on when there's a very good potential possibility that the market is going to go into a very long-term uptrend like we had from 2013 to present, or 2009 if you want to measure the bottom of the market. But even then, it was kind of early to tell if the market was going to reverse and go higher in 2009. But even if you got in late, the market continued to go higher, and you want to have those positions that allow you to benefit from the rise or the decline in the market over a long period of time. And so when I do option trading, and a lot of people think of option trading as very short term, but for me, I love those 6 to 12 month expiration dates. So options for me are, expire 6, 9, 12 months. And I also use futures contracts, and I roll those over. So I'm taking a combination of options and futures for long-term position trading. Typically, I don't use futures in bear markets, and we haven't had a bear market in a very long time, except going back to 2007 to 2009. And even then, I guess technically you could call it a bear market, but it was more like a very large correction. We have not really had a bear market in a very, very long time. I mean, a real bear market that lasted more than a year and a half. With the decline in 2007, 2008, really it didn't start till the summer of 2008, and then it ended in March of 2009. So it wasn't even a full year. And so, it's really hard to communicate to people that there is a potential for a real bear market. That's really hard to get across. I've talked to a number of different traders, and they say, oh, no, it's different this time. We're not going to go into a long-term, protracted bear market over a 2 to 3 year period. It's not going to happen. No, I don't know. I think it will happen. Anyway, and number 3 is very short-term trading. And this, typically I only do it, and this includes day trading, and not day trading options. Day trading options can be a really rough business for a couple different reasons. Number 1 is you've got the spread to deal with. Number 2 is that when you go to sell, it's very, very hard to hit that mid. Very hard to hit the middle of the bid ask. And so you're going to get killed almost every single time if you're day trading options on a short-term basis. That's why I prefer futures. And typically I prefer the YM. Like I said before, it's the one that I grew up with. I kind of know about it. I've been using it, following the Dow since 1987. And so those are the 3 strategies that I use in order to succeed in the market. But I only do short-term day trading when volatility is high or is starting to get higher. The reason for that is because you get some really large movements. And I took a picture of my trading on Friday, a screenshot, showing you, talk about a range. This is 24,100 to 23,700. That's a nice 400-point range there. You can make money on a range like that. If you go back to 2000 and let's go back here. I mean, if you go back into this period, which is 2017, I mean, look at the size of these bars. These bars are really small. There's a couple of big ones in there, but for the most part, the ranges on these days is like 100 points. It's really hard to make money day trading when the range of the bars is like 100 points. Really tough. And so now we're in a situation where we've got ranges of bars for 500,000 points, just massive, massive range of bars that make day trading much more profitable. And also more dangerous if you don't know what you're doing. But these little bars here, oh man, you just get eaten up if you're not following a trend. So typically what I'll do is I'll put on if I know that volatility, especially when it comes to MT volatility, when I see that volatility below 100% starts to turn back up to 80%, you just put on a very nice long-term call position and just let it ride. But now with volatility high, you can actually do. It's profitable to do day trading. So these are the three strategies, if you want to call it, and kind of my long philosophy of trading success is to have investments in each one of these categories. This is less frequent because it depends on volatility. This is on almost all of the time. And then 20% of whatever I make on these two strategies goes into dividend stocks. And I only allocate those on dips. So for example, 2008, 2013, 2015, I added to those. I don't add to those on a daily basis. I add to those when I see a very sharp decline in the market that gives me a buying opportunity because I'm holding these for 10 or 20 years. Now I'm a little worried about some of these positions because of what I see in the markets right now. I copied this. This is a fantastic book. I mean, it's out of date. I don't know what the publication date is on this. The copy that I have anyway. By Arthur Merrill. The one I have is 1984. But it has absolutely incredible details on the market. And basically what he did was he's like, let me just open up another one here. He gave the market patterns. He studied the patterns of the market. So for example, if the market went up 2 days in a row, what would happen on that third day? Would it continue to go higher or go lower? And he studied this over a period from 1897 all the way through 1984. So there's a tremendous amount of statistical analysis in the book that is extremely helpful. And I've used it in my trading and I just absolutely love it. And then what he also did was he compared, and what this does is compare how big of a bull market. Typically, the bull markets from 1897 to 1984, which is the date of this book. And the longest one, up to 1984, was ended in September 3rd of 1929. It was just about 3,000 days. That was the longest bull market in the history of the market going back to 1897, up to that time. You can see like the average was right around 1,500 days, right in here. Little outlier in 1956, went 2,500 days. Now, he didn't include the bull market from, I mean, you could call it 1982, but really after 1987, so we'll call it October 1987 until 2007. That's 10 years, it's about 3,600 days. So that was larger than the one in 1929. The one that we have been in since, we'll call it 2009, which is the bottom of the financial crisis, currently is about 3,265 days, I think I calculated. So it's right in that range, along with 1929, 1987, in 2007, and 2009 now to 2018. So all of them are approximately between 9 and 10 years. Those are the longest bull markets. And so that's where we are right now. So, I mean, what are the probabilities that the market's going to continue to go higher? I mean, I'm only talking about probabilities here. If you knew nothing else about the market, the probabilities are pretty good, and you know what happened in 1929. We had a huge stock market crash, and the market declined 90%. I think the other chart shows exactly what the percentage is. I'll show you that. 1987, we lost 53% in one day. 2009 to 2007 to 2009, we lost about 50%. So the chances are pretty good that in 2018, if we've been in a bull market now for 3,265 days, we're going to lose. I mean, the smallest decline here is 50%. And so we're probably going to at least get to 50%. At 50%, we were at 26,600 approximately, which would bring us down to 13,300 on the Dow. You got to think in terms of probability. Which leads me to my second philosophy, if you will. And that is that, number one, trends tend to last longer than you expect. For whatever reason, people get afraid that, hey, you know, I mean, back in 2011, a lot of people were saying, oh, the market's, you know, gone up quite a bit from 2009. It's probably over now. I mean, every couple of years, they kept saying, oh, the market's probably going to decline. And we had a couple of pretty large declines, especially in August 2015, but they never turned into bear trends or bear markets. We're still in a bull market. And so I'm talking about bull or bear markets. And not only, so it's not just trends, but I'm talking about the market in general, whether it's a bull or a bear. And the trends tend to last longer than you expect. Let me show you. Oh, actually, I should have showed you this chart before, but this is from the book as well, from 1929. Here's the peak of the market. The peak was actually, he has it up here, September 3rd. So this is kind of like a rebound. There were a couple of days here in which the market declined over 4%. Here's 5.87%, and then this was 12%. Those are the 2 days that I talked about from the strong market timer report, indicating that there were 2 days of declines over 4%. And those are those 2 days, which led to a very, very sharp decline of about 32% within basically just a few weeks. I'm not sure what time period this is, but it looks like maybe a 1 or 2 week period. Now we saw a couple of really sharp declines already, over 4%, and so there's only been a few times in which this happened. 1929, 1987, It happened in 2013, which did not turn into a bear market, but it also just happened recently. So that's why I'm extremely bearish on the market right now. So there's also another thing, and there was another picture in the book. This was the bull trends, and the bear trends tended to last 1,500 days on average, if it's a true bear market. So 1,500 days divided by 365 is what? About 3 years or 4 years. So I'm anticipating that the market is probably going to decline over the next 3 to 4 years. There's going to be a lot of rallies, and probably, strong rallies in between now and then. But remember that in the 40 years that I've been trading, trends tend to last longer than anyone expects. And so if we do go into a bear market, prepare for it to last 3 to 4 years. Number 2, daily fluctuations of the market That's not very good writing, but are basically ignored. You really want to look at the overall trend. And the best way to look at the overall trend is on weekly charts. I found weekly charts to be the very best indicators of overall trend. Even daily charts are there's too much noise. If you really want to get a good idea of a trend, look at the weekly charts. Let's pull one up. This is the daily, and this is the weekly. Within each one of these, as the market was going higher, you could see that it was green after green after green after green, and even the little red bars here, you could see there wasn't much progress to the downside. Not a lot. And you could tell that they were just minor fluctuations in a larger trend, which was higher. And now we're getting into, this is up and this is down. That's about as clear as you can get. And, you just want it, the things you want to look for are higher highs and higher lows in an uptrend, and in a downtrend, lower lows and lower highs. There's a lower high. There's a lower high. I could have picked a better color because it's kind of, but you get the idea. You're looking at lower lows and lower highs. And so I almost have no doubt in my mind that we're going to break this low going back to February 5th. If we're going to actually go into a bear market, which I think we are, which is going to last 3 to 4 years. So we've got, I think we may bounce off of it, right, just retesting this low, maybe come back up to some sort of area of resistance, but we're still going to have a lower high. And if we do have that lower high and another lower low, that's going to be a sure sign that we're going to be in a very, very long-term bear market. Finally, the last component of my philosophy for trading success is about psychology. Excuse the handwriting. Number one, in order to be successful, you need to eliminate fear. You can't trade if you're afraid. And fear typically comes from losing. And so if you've lost continually in the markets, you become more fearful. Pretty soon you get to the point where you are frozen and you can't make a decision anymore. And the reason you can't make a decision anymore is because you doubt your judgment. You have to have a view of the market that gives you confidence in your opinion of the market and what it's going to do. When I showed you this chart, it also had some of the lines I drew on it. And this is actually how all of these trend lines I drew when the market opened on Friday morning. And so when the market opened, it was right around in here. We had this overnight action, and I drew 50% of that because I know that consolidation typically means some sort of support area. And so I'm looking at this area here as kind of the major line where either it's going to go above or below it. And then I drew we had a series of higher highs. So even on an intraday basis, looking at a trend, if you have a higher high and a higher low, then the market generally will go higher. And right here was a great opportunity to trade long, which I didn't take because I knew the market was going to decline, because the overall bias of the market right now, and I use Market Timer's MT volatility exclusively as the kind of bias that I want to have in the market, is that the market will decline. So I'm not going to take a long position here. But I did see a higher low and a higher high. So I knew the market would probably take one more stab at least to the high. It did, and it may establish a new high. Immediately it reversed, taking out this complete bar. And that's a perfect opportunity to go short. So even on a short-term basis, you can tell what the trend is going to be based on the markets making higher highs and higher lows in a short-term basis. Now I was looking for my ultimate top if the market got up here in this area, just above 24,172. That's where I was going to take a major short position. Never got there. Started turning around here. But if you don't understand what the market is doing on an intraday basis, don't trade intraday. Don't trade on a day trading basis. But whatever you do, you must eliminate fear. Now, how do you eliminate fear from your trading? Number one is you don't use leverage. We talked about this before. Don't use any leverage at all. If you want to short the DIA, do it in a cash account if you don't want to use any leverage. If you want a little bit of leverage, put it in a margin account and trade it that way. But trade small. That's how you eliminate fear. As you get used to trading, you can increase it a little bit. And then maybe go up to the YM futures contracts. But in the beginning, fear will paralyze you. And so you don't want to use leverage. That's how you eliminate fear. Don't use leverage. Number two is eliminate greed. Everybody thinks that the market's going to go further and faster than it will. Now, we're kind of in an unusual time right now in which we're making really, really big moves in the market. But I guarantee you that people who were short this week, let's go back to a daily chart. People who were short this day or this day coming into this bottom were thinking, and you're going to get a lot of people who are thinking, hey, this thing is going to continue to go lower. It didn't. And especially if they missed a lot of this move already, they're thinking down here, hey, this thing's going to continue to go lower. They go short, and the market immediately reverses on them, and they lose money. Because they think in terms of a straight line. Hey, this is going to be a straight line down. I'm going to go short right in here. It doesn't. It reverses quickly higher. I lose money. The time to take positions is when you know what the overall trend is and you take a position opposite of the current short-term trend. So for example, if you continue to read Market Timer Insights, you know that we were looking for a head and shoulders top here. And so if you were doing your own analysis, which I highly recommend that you do, you would have looked at this rally as an opportunity to take another a short position. And so you don't want to buy the market to go up here. Once it got up here, because we were looking for that head and shoulders pattern, and that was the left shoulder, there's the head. In fact, we even identified exactly what level that right shoulder was going to form at. Preferably, you're a position trader and you added puts or a put at that level. And if you didn't, that means you were afraid. You were afraid that the market would continue to go higher. This current leg, and like I said, most people think in terms of straight lines. So, they're thinking, all right, if the market's going up, it's going to continue to go up. When instead, if you don't know what the trend is, you're looking instead for an opportunity, where's that chart, to go down. And so you're looking for an opportunity to buy a put right in here. You can't extend trends straight up. And even the trend right now, is, where is it? At some point, we're going to get a bounce. Now, if it hits my target at 22,600, then, I'm going to be looking at maybe taking off some of the put positions I have. But remember, those, the trends tend to last longer, but they never go in a straight line. Ever. So at some point, we're going to get a bounce. My guess is going to be in this area because of the measurement of this head and shoulders pattern. And then, so to eliminate greed, you can't think in linear terms. Markets don't go straight up and they don't go straight down. They go something like this. And number 3, think strategically. Try to think as strategically as possible. Think of. This is a serious business, but you can think of the market as a chess game. So the market is making its move. And you have to decide what move you're going to make in response. Are you going to buy it or are you going to sell it? So every time the market makes a move, you have to know ahead of time what your game plan is. You have to think 2 to 3 moves ahead of the market, just like you would in chess, or more. 2 to 3 moves, or maybe even 5 or 6 moves ahead. So, in other words, when we did see this right shoulder being formed and it was right at the area that we thought it was going to form, that's a time when you have to make your move if you want to win this game. And that's something that is, you have to get used to doing that, and you can't have fear when you're making your move. And the way to eliminate that fear, like I said, is don't use leverage. So if you're afraid of losing money because you think this, and you're thinking in linear terms, and that this market is going to continue to go higher, right at this right shoulder, you think, hey, this thing could go to a new high. If you use a lot of leverage, over leveraging your position at this point, you're going to be afraid of losing money. And that's the thing that you don't want to do. And so you use less leverage, but you get in at a fairly good price. And you always want to take a position in the direction of the major trend. And this is super important. This is absolutely critical. You want to take a position in the direction of the trend, and we're going to call the trend down. The trend is down. We've got enough evidence with these 4% down days to indicate that the character of the market has changed, and this market is going to go lower. And so you want to take positions after the market rallies, in the positions are in the direction of the major trend. So on this counter trend rally, you want to go short and you want to hold it in the direction of the major trend. Here, counter trend to the trend, you want to take a position short or add to the position that you have. And this is position trading. So as the market reversed here higher, you take a position. Reverse goes down, comes up higher, but still below the low. You believe the trend is lower. You want to add to your position. And even if it's only 10 diamonds or 1 diamond, whatever you feel comfortable with. We identify a potential head and shoulders pattern. We get another counter trend rally. You add to the position again. So now you're adding positions as the market trends counter to the major trend. And that's what you want to do.